bottlenecks are not necessarily your fault. It's not necessarily that you did something wrong, but they are your job. It is your job as the business owner to identify the financial bottleneck and to then work towards solving it. And it's not necessarily an overnight fix, but it is your job to see what's going on in your practice and to then work towards improving it so that you can make your practice better. You didn't start your practice to barely hang on. I'll guess you started it for freedom, impact, and profit. This is Therapy for Your Money. I'm your host, Julie Harris. I'm an accountant, author of Profit First for Therapists, and CEO of Green Oak Accounting. Over the years, my team and I have partnered with hundreds of private practice owners, whether they're just getting started, scaling into thriving groups, or even preparing to sell. We've seen it all, and we know exactly what makes a practice tick financially. On Therapy for Your Money, I'll help you build a business that truly works for you. You'll get quick, actionable tips and episodes so that you can grow a profitable practice, increase your financial confidence, and pay yourself unapologetically. Because your work is way too important for you to burn out or go broke doing it. Love the podcast? Make sure to follow and give us a 5-star review. Here is Therapy for Your Money. Hello. Welcome to Therapy for Your Money. Today is part 2 of a 2-part series on cash flow bottlenecks in your practice. So if you missed last week, definitely go check it out where I talked about cash flow bottlenecks with cash coming into your practice. This week, I'm talking about cash leaving your practice, i.e. expenses, right? Expenses, dollars that you are spending in your practice and where those common bottlenecks exist. This is material from a keynote presentation I did for Group Practice Con. That's grouppracticecon.com if you want to go check it out. That was a live group practice event that I did in partnership with Joshua Brummel from Therapy Flow in September in Chicago. So if you're interested in some really business-focused events where you can learn how to get to that next million or really scale your practice, where we talk about all business things like finance and marketing and hiring and recruiting and all those fun and exciting things, then check out grouppracticecon.com. So in today's episode, I'm going to go quickly between the items because there are actually 6 cash bottlenecks that most commonly drain the money out of your practice. So if you've ever felt like, cash feels good, we're making a lot of money, but like it still feels really tight. There are some expenses that just creep up on you and things that eat away at your profit margin. And so today we're exploring where money gets stuck or where it leaks out of your practice sometimes without you knowing. So our first one is fixed expenses. Sometimes your fixed expenses are going to be more than your income can really sustain. So a fixed expense is typically something that is going to stay the same regardless of how much money is coming into your practice. The kind of other most common expenses of variable expense, fixed versus variable. Think of a fixed expense as rent. Your rent is the same dollar amount every month, whether you make one single dollar or $100,000 in your practice, right? Assuming you have that same space. Your administrative team could be the same, right? So if you have one full-time intake coordinator, you are paying that person for 40 hours a week, whether there is one patient seen or 100 patients seen, right? So those are fixed expenses. They don't shift when your income goes up and down. A variable expense would be something like payroll. If you have, specifically for your clinicians, if you have one clinician, it's going to be a certain amount. If you have 3 clinicians, it's going to be higher, right? Obviously, the more clinicians you have, the more that goes up. So that's a variable expense. So fixed expenses can be a bottleneck when you have investments that you have made that sometimes are done ahead of time, right? You might be hiring ahead a new admin where you really need income to rise to meet that occasion, but it has not yet. You can also see that happen when you are making investments in a bigger space or additional space, right? Something along those lines where you really just need the income to come up to match that level of expenditure. So when expenses are a little bit too high for the practice, that can mean you might have had reduction in income recently, and there may be changes that need to be made in those fixed expenses because they no longer match. Or you can look at that and know, okay, we made investments ahead of time. It's going to be a little bit tight for now, but we are going to get back to a place where that is okay, right? So that's an area where you want to look at the fixed expenses because those are coming no matter what every single month. Area number 2 is growth and expansion. So if you are rapidly hiring clinicians, adding new locations, your cash is just going to get stretched. That's just how it goes, right? It takes money to generate more money and to expand a practice. So a couple of ways that you can help fix that or alleviate that is to slow down. That is something that is absolutely on the table. So grow less fast. You can also build cash reserves before an expansion. You can hire based on the pipeline, not necessarily on hope. You can work to fill your clinicians up much more before you hire the next person. And you can really look at return on investment for all of the expenses that you have for your growth and expansion and focus on the items that are going to make you most money. What do I mean by that? If you are planning to buy, brand new furniture because you're moving into a new space, that furniture itself does not have a direct return on investment. You can furnish it with great finds from Facebook Marketplace, and that will cost you significantly less and still get the job done, right? The important thing is you can't have clients and clinicians sitting on the floor. You do need something, but it doesn't actually have to be brand new. So you can instead focus on things that are going to have an immediate return on investment, like hiring or marketing, things that are going to be necessary and that you actually do need to spend money on. The third bottleneck that we often see, and it's number 3, but it's one of the very common ones, is clinician compensation. If your clinician compensation is more than 60% of the gross income of the practice, that's all the dollars coming into the practice, there's a really good chance that the profit margin is struggling, that the profit margin is not where it should be. I have pretty much never seen a practice where clinician compensation, that's wages, payroll, tax, and benefits, is more than 70% of gross revenue that has a profit margin more than 10%. Almost impossible for that to happen. Almost impossible. So the higher above that 60% line, your clinician compensation, again, wages, payroll, tax, and benefits, is, the less likely it is that your profit margin is going to be sustainable. So that's a hard one for a lot of practice owners to hear. That's really, really hard to hear, but the math has to math. Your clinician compensation has to make sense, or there are some situations where you would be better off letting someone go and you would actually have more money left in the practice, because everyone else, including you, is working hard to offset the cost of that clinician. I've seen many, many, many times over the years that happening. Number 4 of financial bottlenecks for cash going out, personal expenses. You might have this situation where the profit and loss shows profit, but cash is really tight. Maybe there's a lot of personal expenses flowing through the business. Maybe the owner is not paying themselves consistently, but rather like just taking cash willy-nilly out of the practice, right? Not necessarily on a specific rhythm or specific amount. They're just taking whatever they need. That can be a problem when there is not a specific dollar amount moving from the business to you on a regular basis. You don't necessarily know what you have to spend. And so sometimes that can lead to you personally putting the business at risk. It's rarely ever intentional, but that can happen when you're just taking out as much as you can and you're not leaving enough in for reserves, for next payroll, for the expenses that are coming up. You're essentially strangling your practice, right? By taking out all of its cash, you are chopping it off at the knees, and it is having a hard time surviving because you were taking all the money out. So having an intentional plan for how much you're going to get paid, what you need to take home, all of those are great ideas and are things that are going to help you make sure that you are not putting your business at risk. Number 5 is debt. High monthly payments can really squeeze your cash, even with a strong profit. Profit on the profit and loss, right? The profit used to pay down debt. That's what's going to be used to pay down the principal portion of your debt payments. Your principal portion does not show up on the profit and loss. So it might look like you have a lot of profit on paper, but a lot of that cash is going right back to pay down debt. And so if you have debt with high interest rates, you can look at prioritizing those high interest rate loans, refinancing or renegotiating terms, maybe rolling all of that debt or credit card debt into one payment. But when you are doing that, you've got to fix the behavior that led to all of that debt as well, right? Because if you're just going to keep using the credit cards and keep accumulating more debt, that problem is not going to go away. You need a plan to ultimately reduce the debt and pay it off. Obviously, Profit First is a great way to do that. I talk about it often in the podcast just because I wrote Profit First for therapists. So that's a great way to stop the bleed and pay off debt. And so I encourage you to check out Profit First if that's the situation that you're in. And then our last bottleneck for today, last but not least, is shiny object syndrome. I see this happen so often, specifically with larger groups or starter groups, where there's always like, oh, the next big thing, like this is going to fix everything. If you have ever been in a situation where you have told yourself that, like, oh, this is going to fix all of our problems, there is no tool that's going to fix all the problems. There are still going to be problems in a business no matter what, right? We're just dealing with different problems as the business shifts, as the business grows. That's just a normal part of being a business owner. So if you're constantly evaluating new tools, trying new things, buying new systems, that means you're probably also then forgetting about them and tabling them. And there's possibly a lot of things that you are paying for on a regular basis that you are no longer even using. So I would look at what is the return on investment for these things that we are using. Are there subscriptions that we can get rid of? I would also really look at limiting changes to once a quarter. If you have been doing a lot of different things, making a lot of changes on a regular basis, slow things down. Your team might be exhausted from all the new things that you are trying to roll out. I have been guilty of that. Your team might be exhausted because you're constantly trying to add new things. If you find yourself constantly comparing yourself to your competitors or seeing a new thing in a Facebook group and saying like, oh, I'm going to try this. This is going to be the thing that fixes it. Slow down. You'll notice in a lot of these bottlenecks, slowing down is actually something that can work really well. Give yourself a cooling off period. Maybe that is sleeping on it overnight, a 30-day period, a 90-day period. But before you make a commitment to something new, slow down and see if the excitement wears off, because you might be spending a lot of money unnecessarily. Also, a lot of energy, a lot of mental load trying to test things out constantly and see if it works or if it works better, right? If it works marginally better. But you'll notice as your team gets bigger and bigger, there's a financial cost to everything, but there's also that social and emotional cost to rolling out something new. It takes a lot of time, mental load, and energy to get the team on board, to get everyone converted, to get everyone used to it, all the training that needs to happen. There's a real cost to that, both mentally and financially. And so it changes things. You're not able to move as quickly from one thing to another the larger your team gets. You need to give it more runway and more bandwidth before you make these big changes because it impacts so many people in your practice. So bottlenecks aren't necessarily something that is going to be like, oh, it shows up and then I fix it and then we're done forever, right? It's going to ebb and flow over time with your practice. And different bottlenecks may pop up at varying points of your practice as well. So something can come up multiple times in the life cycle of your business, and that's okay. That's going to be all right. That is just something that you have to work through. As I mentioned in our previous episode, bottlenecks are not necessarily your fault. It's not necessarily that you did something wrong, but they are your job. It is your job as the business owner to identify the financial bottleneck and to then work towards solving it. And it's not necessarily an overnight fix, but it is your job to see what's going on in your practice and to then work towards improving it so that you can make your practice better. Ultimately, that's what your job is, right? Improving the practice day by day, a little bit better every single day, ultimately will lead you to a great practice that you love and that you are happy to work in every single day. So that's it for a 2-part series on financial bottlenecks. I hope you learned something new, and I'll see you next time. That's it for today's episode of Therapy for Your Money. Catch us on Instagram and Facebook at Therapy for Your Money Podcast, and don't forget to subscribe to Green Oak Accounting on YouTube. Until next time.
The information contained in this podcast represents the host and guest's general opinions and should not be construed as personalized accounting and tax advice. Listeners should consider all facts and circumstances before applying this information and seek appropriate advice from an accountant, financial planner, lawyer, or other professional. Any info provided does not constitute accounting, tax, or legal advice.